Why is securing Series A funding becoming an increasingly daunting task for seed-stage startups? Welcome to our deep dive into the current state of venture capital funding. In a recent article featured on TechCrunch, it was reported that Series A funding is becoming more challenging for seed-stage businesses. These startups are facing a new reality of lower valuations and more selective investors. Venture capital firms are responding to this market shift with innovative solutions like mentorship programs. Lightspeed Venture Partners, for example, has launched a company-building program named Launch, designed to help founders navigate the path to Series A funding. The same report also highlighted a shifting emphasis in the funding landscape. Year-over-year growth and annual recurring revenue are becoming more important at the Series A stage. With thousands of venture-backed companies going out of business in 2023, the focus has shifted towards building a sustainable business with a customer-centric approach, profitability, and cash flow. An article from Business Insider echoed these findings. The time between funding rounds is getting longer, and the venture capital funding in 2023 has been the lowest since 2018. PitchBook analysts expect the VC market to continue operating under these challenging conditions. In the third quarter of 2023, startups that raised a Series C had an average time of 1,090 days since their last Series B. Meanwhile, those that raised a Series A had an average time of 787 days since their seed round. This represents a significant extension in the funding timeline. Late-stage investing is also affected, with fewer venture capitalists writing large checks and higher expectations for companies in return. Startups that fail to hit milestones or demonstrate progress towards profitability are facing considerable hurdles in securing future financing. Several startups, including Olive AI and Convoy, have already shut down due to these challenging market conditions. In summary, seed-stage startups are facing significant challenges in securing Series A funding. Lower valuations, more selective investors, and a shift in emphasis towards year-over-year growth and annual recurring revenue are defining the new landscape. Furthermore, longer times between funding rounds and the lowest venture capital funding since 2018 are exacerbating the situation. Venture capital firms are responding by offering support and mentorship to their portfolio companies. However, the onus remains on startups to build sustainable businesses with a customer-centric approach and a focus on profitability and cash flow. Failure to do so can lead to a harsh reality, as seen by the closure of several startups in the face of these challenging market conditions. As these market dynamics continue to evolve, startups and investors alike will need to adapt and innovate to navigate this new reality.